Learning from other people's mistakes is one of the smartest things you can do. Here are 9 mistakes that you do not want to repeat. Starting off with number 1, which is trying to time the market. Timing the market is a challenging task, and while not inherently bad, it remains extremely difficult to accomplish. If it were that easy, those who could accurately predict the market's movements would amass enormous wealth. However, even professional fund managers struggle to consistently outperform the overall market average. Instead of trying to time the market and find the perfect moment to sell, a wiser approach is to invest in reliable and promising companies. And as the saying goes, predicting the rain doesn't count, building arcs does. You're better off investing into good companies that will help you in all volatile situations instead of trying to predict the market crashes. Furthermore, timing the market requires you to be correct twice, which is a challenging feat indeed.
We haven't the faintest idea what the stock market is going to do when it opens on Monday. We never have had.
Number 2, we have selling too soon. There are many topics and resources talking about how and when to purchase stocks. However, it's important to remember that it is equally crucial to develop a well-defined strategy for holding or selling them. Investors must carefully assess various factors before making investment decisions, such as their risk tolerance and the timing of their financial needs. A common mistake investors make is selling a great business when its stock value declines. Emphasis on great business. This behavior is driven by emotional impulses and the fear of further losses. However, it is essential to recognize that selling a stock solely because it is going down is a flawed approach. When stock prices decline across the market, it presents an opportunity, especially for high-quality businesses. It's like stumbling upon department stores with 50% off signs. Instead of feeling worried, you get excited about the chance of buying things at discounted prices. Similarly, when good businesses' stocks go down, it's a time for potential gain, not panic. The same principle applies during a stock market crash. It's like if the shoppers were leaving the stores during a sale, which seems peculiar. However, if you hold exceptional good quality businesses with robust competitive advantages and minimal bankruptcy risk, it's unwise to sell solely based on short-term price fluctuations. Following Warren Buffett's advice, worrying about the stock market correlations shouldn't deter you from owning stocks. Stock prices will inevitably go up and down, but the key is to invest in something you believe in at a price you find favorable and hold it for a long time. The next mistake that investors make is listening to others. So I ask you from this point forward, please stop listening to what I have to say. I should probably say only listening to others. Relying on someone's opinion to make a buying or selling decision in the stock market is often unwise. The modern era throws us with an abundance of information. While some of these opinions may appear persuasive, presenting a lucrative opportunity, not all are reliable. Acting on every opinion without discernment is a recipe for financial loss. It's essential to exercise caution and critical thinking when considering external advice in the ever-adapting pool of information available today. As a safeguard, do your own due diligence. This can be time-consuming, but in the end, it will absolutely be worth it. Think about it. If you lose money on an investment you made without doing any research, you will forever beat yourself up for it because at the back of your mind, you'll know that there was always that chance to avoid that loss if you simply did your own due diligence. The next mistake is neglecting to start or continue. Many individuals refrain from initiating an investment program due to their limited understanding of where or how to begin. Similarly, periods of inactivity often stem from a lack of motivation or discouragement resulting from a past investment loss. Investment management is a discipline that is not overly complex, but requires continual effort and analysis in order to be successful. The only thing you are doing from not investing is keeping yourself away from potential gains. There's this quote that I really like. It goes, "If you're worried about the cost of getting started, you should see the price of staying exactly where you are." Mistake number 5 is keeping hold of losers. So one of the primary challenges investors encounter is deciding how to handle declining stocks. Some opt to sell quickly to limit their losses, while others choose to hold on and wait for potential recovery. However, when a company's share price is plummeting due to fierce competition, stagnating growth, or risky management decisions, it may be prudent to sell. As Warren Buffett advises, if you find yourself in a hole, stop digging. Holding onto underperforming stocks in the hope of a turnaround can lead to a major mistake. Instead, cashing out, reassessing your portfolio, and reinvesting in promising opportunities can prove to be a wise decision, ensuring that you could change your strategy at the right moment and invest in companies with strong potential for success. Please don't confuse this with keeping a hold of good companies even though the market is going down. Investing in good versus investing in poor companies is a very big distinction here. Mistake number 6 is being distracted by headlines. Sensational or negative news stories have a captivating effect, driving newspaper sales and online clicks. Consequently, some investors may feel anxious, fearing that such news might spook the markets. With the advent of the internet and real-time news, there always seems to be something worrisome on the horizon. In the past 5 years alone, events like COVID-19, conflicts in Ukraine, and cost of living crisis have fueled concerns, leading to many to enter panic station mode. However, we often underestimate the market's resilience as they typically incorporate people's worries into their pricing. When genuine surprises occur, the key lies in avoiding impulsive decisions. It is essential to assess whether the event genuinely impacts your investment's value or long-term potential. Markets tend to rebound faster than anticipated, making it advisable to maintain patience and weather through challenging times. Mistake number 7 is investing into things you don't understand. Be cautious of who you trust as your advisors and ensure that you thoroughly understand the fundamentals of any investment. If you can't explain the investment comprehensively to someone, then it's best not to invest. The simple rule alone will protect you from a lot of potential trouble. Mistake number 8 is expecting too much or using somebody else's expectations. Long-term investing entails building a well-diversified portfolio that aligns with your desired risk and return levels across various market conditions. However, even with a well-crafted portfolio, predicting or controlling actual market returns remains elusive. It's crucial not to set unrealistic expectations and to approach return estimations with caution. Determining a reasonable rate of return requires a thorough understanding of your individual circumstances, goals, and current asset allocation. There is no one-size-fits-all answers. Instead, personalized consideration is necessary to gauge appropriate expectations for your investment journey. Mistake number 9 is trading too much and too often. Frequent adjustments to investment tactics and portfolio compositions can lead to lower returns due to increased transactional fees and possible taking of unforeseen and uncompensated risk. Instead of hastily reconfiguring your investment portfolio, take the opportunity to learn more about the assets you hold already. Use the impulse to seek knowledge and understand rather than engaging in unnecessary trading activities. Being mindful of your progress and continuously learning will ensure that you stay on the right track towards achieving your investment goals. And I included a bonus mistake that investors make, and it is simply not buying an Apple stock in 2001. Thank you for listening to Pareidolia. This is all things business, money, and economics.